Freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
Welcome back to Wealth Independence Podcast, where freedom leads and real wealth follows. Today, we're going to be talking about the news. The Ukraine just launched some missiles at Russia, and they struck back with ICBMs, with non-nuclear warheads. But you don't think you think Putin's smart enough not to start World War III?
So, the short answer to that question is yes. But I'm curious, what's the obviously this makes headlines and everyone's worried about it, but to bring things back to a financial kind of point of view, the question that I have to ask is, what are we to actually do with this? Everyone, this triggers the concerns of war and World War III. Obviously, trigger a lot of fear and stokes fear, and it plays well on sites like Zero Hedge, where everyone, most of the reader base just assumes that, everything's about to collapse.
The world is ending.
Yeah, I mean, they definitely follow it's a lot of the Robert Kiyosaki and Peter Schiff and those types of people that plays well too. But end of the day, the question that I always have to ask is, okay, well, so what? What do I do? And what actually matters? And I mean, if there's World War III, thermonuclear war all over, and we all die, none of this matters. It's completely irrelevant. It's also something that's 100% out of my control, right? I can't. There's no point in me planning for World War III. We can, if we want to talk about that realistically, I think this doesn't become a financial conversation. It becomes a prepping conversation, right? We're talking about storing food and ammo and being able to purify water, have access to fresh water and things like that. So that's why, I feel like most of these fears, it plays well. People like to pay attention to it because it triggers that fear part of our monkey brain where we go into survival mode. But end of the day, from a financial standpoint, it just doesn't matter. If it happens, then none of the financial stuff matters. And I firmly believe that it's most likely not going to happen. We're not going to have any issues. Everything's just going to continue on. And so we should not be worried about World War III starting, but we should be worried about how we're allocating our portfolios and deploying capital, given maybe some more near-term concerns, or not concerns, but considerations at home. So that's my World War III take.
Well, okay. But obviously all those news headlines lead to change market volatility. They lead to possible changing oil prices. I mean, we saw a massive spike in the price of oil, and especially the cost of gas for most of Europe, or all of Europe, when the Ukraine-Russia war started, with them not, the pipelines and the gas coming into Europe, which is their primary heating sources. Now they're getting a lot of it from the U.S., and that just drastically increased just the cost of good. The PPI went up like crazy in Europe, and Germans are good at building stuff, and their PPI went to 10%. So what does this mean to a general investor's, you say portfolio allocation is what we need to be worried about, but what do you do?
Are you saying I should be concerned about the PPI in Germany, that's going to change how I allocate capital here in the U.S.?
I think to a certain extent it's something you could read, right? I mean, I've always thought, or at least been told, that you look at German knives, German cars, that they're good at producing things, right? They have good production facilities. And so if they are a leading indicator for the cost of production, either through labor or energy costs, some of that could then trickle down to other parts of the world.
I mean, I'm way less concerned about that. I think you're right, but then the question that I would have to ask is, okay, well, what percentage of any of that stuff actually could be impacted by it, right? I've seen this. I've seen some interesting analysis. There's a lot of concerns right now around what Trump's wanting to do with tariffs from Chinese goods, and you got everyone assuming that that's just going to inflate the cost of everything. And I think that's a very ignorant maybe point of view. very inaccurate. I think specifically for real estate, you have to sit and look. It's like, okay, well, for construction, how many of the things that go into building a house do we actually get from China? And the answer is not a lot. Maybe, you got some of the finishes and some of your final things, but what was actually announced, just in the last couple of days about him wanting to do, I think it was a 20% tariff on goods from Mexico and Canada.
Yeah.
So we get a lot of lumber from Canada, right? So that could potentially have an impact on construction costs. But overall, if you look at like where things actually come from and where they're sourced and how they might impact like specific situations, I think it's a lot of this is just, again, it's triggering the fear parts of the brain, but end of the day, it's not something that's really worth, like it's not going to move. So I guess I'm forming a lot of these thoughts on the fly here. But to sum it up, I think there are, what's going to move the needle more is how many new apartments are coming online in a given city than what the German PPI does, right? That's going to impact my rents, my ability to push rents, my NOI. Like if I'm thinking about especially real estate investments, that's the thing that matters much more to me. So sure, maybe we can make some argument that there's this, throughput that the German PPI increases cost somewhere, and so that's roughly inflationary. But I also think the further away you get from just basic supply and demand, the more you're extrapolating, and then the more other things can come into play that you're not accounting for that completely throw your thesis off. It's one of the reasons I don't put a lot of stock in a lot of macroeconomics. It's extrapolation of current trends without any consideration for other things that could happen, or people saying, no, we don't want this to happen, so we're going to do something that's never been done before to prevent that from happening. And that gets into a whole other longer discussion about my feelings on macro, but that's, I generally just, to think about some of these concerns. Yes, obviously, like there's some things that would have an impact on, say, the price of oil. We've done some oil funds that would be directly impacted by the price of, say, West Texas, right? Like that. If West Texas, if the demand plummets, and so price for West Texas Intermediate drops, then we've got a big potential problem there, right? That's going to negatively impact some of our active investments. But beyond that, I try to not look too far out from like what's going to have the most needle moving impact on the things that I actually own or that I actually invest in.
So you made an interesting point there around the tariffs that were proposed on Canada and 20% tariffs on lumber. We got a lot of our lumber from there, building apartments. We're already expecting, me and you and some other people we follow are expecting a shortfall of housing coming in 27, 28, maybe even a little
26.
earlier, because 26, because of the apartments, the construction starts have stopped, right? Higher rates and higher construction costs. There's not a whole lot of new development in the pipeline. I mean, you can look at the new housing starts, right? You're just not seeing it. And so how, if we paired on those tariffs, right? Because the whole argument with tariffs is it'll bring back that production inside the U.S., but I think lumber is a good example of where that might not be as easily the case. How does that pair with our thesis around housing?
Yeah, I think the thing a lot of people miss, and this especially the tariffs that were just, or the potential tariffs that were just announced on Mexico and Canada. I honestly would be shocked if those actually come into place or are in place for any significant period of time. I think Trump is going to use the tariffs as a bargaining chip to accomplish other political objectives. I even think there's a question, we can, again, this goes back to like extrapolating things out. We start looking at, okay, if these, like, we don't even question, are these going to stay in place? It's like, well, Trump said he's tariffing this, so we're going to, like, what's that going to do to cost? And the question is, well, why are the tariffs in place in the first place? And if it's as a negotiating tactic, and then the other countries agree to negotiate, and the tariffs come off, then there was much ado about nothing. And so I think that's an important thing to remember at the beginning. The point here is, yes, like to have this America first and ideally bring some manufacturing and some of the things back to the States, but the greater impact is really as a bargaining chip against the other countries. So I think that especially applies to Canada and Mexico. Then the question of how do we factor any of this into, so China might be a slightly different story. My thoughts on that again come back to how much of what are my investments exposed, like what are my investments exposed to, and how much of that comes from China or might be impacted by this. And I think the thing to remember is that it's not, the tariffs have never been, even when we had the trade war back in 2018 and Trump was upping tariffs on Chinese goods, it wasn't across the board, right? It wasn't every single thing coming out of China. They were targeted at certain types of goods or products. And so this is all getting mishmashed, or it's getting mixed up into one big discussion, but in reality it's a lot more nuanced than that. So the question that I would have is, okay, what am I exposed to? If it's apartment buildings, then the really would be the expense side of my P&L is what I'm concerned about, right? Like where might my expenses go up? And then the question is, of those things that might go up realistically because of this, how much exposure to China actually is there? And not even China as a whole, but now, okay, is this a product category that's likely to even have tariffs put on it? So it's a very new, like we talk about this, and this is why like I don't want to like brush it under the rug, but I think generally there are other things, again, that will move the needle more than this, right? Like if you, going back to supply and demand, if like, ultimately, if we have tariffs and expenses go up, but we start to see the supply in apartments crunches like we expect it to because there's no new apartments coming online, and that squeezes supplies and that starts driving up rent, at that point, you're talking about really it's going to negate any minor impacts from tariffs that we might see. And that's what I'm saying. That to me is the bigger story. That's the bigger needle mover.
The demographics are outweighing the small impacts that you're going to see on changing supply costs.
That's what I think. And again, this comes back, like I'm not saying this is the case across the board, but specifically for the types of things we invest in, mainly real estate, like that's what I look to is what's the impact going to be there. And yes, I think that those, again, it's not so much of like, can this thing happen, but okay, if it does, how much is that, like what's the impact going to be? It's not just the likelihood, it's the magnitude.
Makes sense.
So I don't know, those might be some contrarian viewpoints. I tend to try to not let myself get sucked into a lot of the fear mongering and the headlines that are going on right now, which of course most of the headlines, even in the financial press, I'm aware, are biased and they're intended to make a candidate that they did not want to see in office look bad. And so I'm aware of that too, and I think that's another just general lesson is remember to read everything with kind of a critical eye and try to understand the viewpoint of the person who's writing it and the inherent biases that they may have.
Anything else on that you want to cover?
No, not really. I think this, talking about inflation and potential inflationary aspects, kind of I don't know if we can talk about this this Wall Street Journal article that I sent you earlier in the week. I thought that's might be a good segue into that. Unless you got something else.
High level thoughts on that, because I've got something kind of related to the oil in general. Because the Wall Street Journal article, do you want to share it?
Okay. So this was from earlier this week. Shows it was yesterday. I actually think this came out in the weekend. But it caught my attention because it was talking about inflation and protecting against inflation, right? And that's obviously something we talk about a lot in the real estate world, is that real estate is an inflation hedge, right? And so we'll throw a link to this in the show notes, and anyone can check it out and read the full thing. But basically, the point that this article was making was that usually in the past, most typical investment advisors would point to investing in commodities as protection against inflation for exactly the reasons that we've discussed, right? Oil goes up along with the price of everything else, and then that can kind of protect you. You have a hedge. You continue to ride that up.
Oil being the backbone of everything that's produced. So it's the energy that creates everything else.
Exactly. And it's interesting. I mean, this is basically the point, or the argument that this article is making is that we might be starting to have a or that we currently do have in some ways an oversupply of oil. And that there's somewhat of a mismatch between, or there's a mismatch if you're looking for the price of oil to go up. There's a mismatch between supply and demand. There's less demand than kind of anticipated. Again, we can debate the merits of that. Go ahead.
Is that due to the softening economy? Because the top line demand doesn't normally change drastically, except for in like economic shifts, correct?
Usually, yeah. And I think it's interesting. It says that the article says here that, oil protects against one of the causes of runaway inflation, which is a soaring oil price resulting from strikes on oil facilities in the Middle East. Yet that's become much less likely. Shocks to the supply are being dampened by large stocks and excess production capacity, as well by our status, the U.S.'s status, as a net exporter. As compared to previous eras, right? In the 1970s, we were definitely not exporting oil, or we were not a net exporter of oil. And so in some ways, we have insulated ourselves from those supply shocks. And so thinking that, to the point earlier about events in the Middle East and the Ukraine-Russia war, we've been somewhat insulated from that because we're producing, we are a net exporter of oil, right? We're producing more than we consume here.
At some point, though, that will begin to decline, though, because if the oil price falls too low in our own local, U.S. economy, shale drilling, which is our number one producer, is no longer profitable, right? It's not that good old vertical drilling that just the wells just produce because there's pressure and there's oil to be made, right? You've got to go in and frack, and they're rapidly declining. So if the price of oil falls below $60, $65, it's not very economical to go bring more of those large fracked wells online.
That's true. No, and that's that's kind of the last point that this article makes here is basically saying, Trump's obviously famous quote now, "Drill, baby, drill." That increases supply, and again, so many things come back to supply and demand. And what happens if you increase supply and demand stays steady? Prices go down. But to your point, there could be an inherent floor, right? At some points, the price drops so low, it's no longer profitable to drill. And so that then some balances supply out. And, there's a lot of inputs on this. But what I definitely think is true is that the idea that events in the Middle East would have this massive shock on us is definitely not true, or will not be. Those impacts will be muted as long as we remain a net exporter of oil. The article, the other thing it talked about here was stronger growth. Again, this is certainly up for debate, but basically saying that the growing economy basically the economic growth could outpace inflation, right? Like if you end up with a growing economy, then the effects of inflation are not as pronounced, and you can kind of like grow your way through that. So again, the point of this article is that the traditional ways of protecting against inflation either won't work or may not matter. And so that this is yet another way where it's saying, well, you could still invest in traditional inflation hedges, so to speak, and yet they may not function in that capacity because inflation could be muted by other factors. And the third here, I thought this was interesting, and this is something I've been saying for a while. It's talking about Trump's the tariffs, which we talked about, but the migrant deportation plans. And I've said for a while that's very inflationary. It's inflationary from a wage standpoint for several reasons, and then it's also deflationary on rent growth. Right, wrong, or indifferent, the more people you have in the country, the more demand there is. Regardless of how those people get into the country, there's still more demand for rental housing. And if you start taking a large portion of the existing population and they're no longer here and no longer looking for housing, that decreases demand. And again, supply and demand, what happens to a constant supply? If the demand drops, you get reduced prices. So this is something that I'm definitely watching closely. Trump's guy on this has been very vocal about carrying out these plans, and there could be a lot of impacts here. Again, I'm more concerned about the deflationary impact on rent, but then you think about the impact on labor, and particularly in places like agriculture, hospitality. if you have a harder time hiring people there, that either you can't harvest as much, it's going to reduce supply, or you end up having to pay workers more. If you increased wages, while a good thing, obviously, for American workers, that's inflationary, right? It was one of the key things that I think we saw through COVID. Everybody started getting a raise, and that more than anything will be inflationary. When folks start seeing wage growth, they've got more money in their pocket, they go out and spend more, and it just kind of creates this self-perpetuating cycle. So again, good and bad. You get American workers being able to earn more in roles that they may have not been able to, but then that in turn definitely is a inflationary pressure on the economy.
I think another thing that, especially as we're going through an administrative change here, I've got an article pulled up on Zero Hedge, if you want me to share it, for Trump's 2 new energy cabinet members.
Yeah.
So, we've got Chris and Doug here, and one thing that I thought was interesting in this article is they're both oil guys or energy guys. They've got a lot of experience in the energy space, but he has an interesting point here. It's a quote, and it says, climate change is real and global challenge that we should and can address, but he goes on to say that there's more urgent threats to humanity, right? About malnutrition, access to clean water, air pollution, epidemics, human rights, other things, right? And so I think there could be a lot of changes to the Inflation Reduction Act, which didn't really reduce inflation. But if you look at this, it seems like he is more even interested outside of oil with, an interest, and I think this is where maybe we could see amendments to the Inflation Reduction Act saying that there's more subsidies or tax credits going into research for, geothermal, small modular nuclear reactors. I really think are probably what we're going to see across the U.S. in the next 50 years. Wind farms are not going to be outpacing oil. I'm sure that there is more oil and energy used to create one of those than they create in their entire lifespan. Solar is not recyclable, and it's got massive amounts of silver in it that's not sustainable, as well as producing a small amount of energy paired with if the sun goes away, it doesn't work at night.
It's crazy. You can't produce energy at night.
But a small nuclear reactor would, and I've been in conversations with Chris Martinson about this, and he's like, there's small ones that he would feel safe putting in his backyard on his pasture where his cows are. He's like, they use a different fuel source, and they basically have an internal meltdown reactor that it shuts itself down if it goes into a meltdown. Yep. And I think that is probably going to be more to what we're looking to see. So it's interesting to me to see a new energy secretary that will possibly push towards these more realistic alternatives to oil. I mean, I completely agree. We need to get the world off of oil, but wind farms and solar and batteries are not the answer.
Yeah, I 100% agree with that. I think the future of nuclear is very, very bright. And I think you said it's going to be kind of the main thing over the next 50 years, and I completely agree with that. That's, you talk about always looking for opportunities, right? And so the question that I've had is, okay, where do the opportunities in that space lie? Is it, and really for me, I always go back to where are the real estate opportunities in that? And I can't claim to have done enough research to feel like I can speak to where I feel like they are, but it's something, it's a trend to watch, right? This is a very long-term trend that's going to play out over decades, and it's going to produce numerous opportunities in various ways, and in ways that we can't sit here today and figure out. And probably with technologies that don't even exist, right? I had a conversation with a wealth advisor the other day, and we were talking a little bit about oil and energy in general. And one of the things he brought up that was interesting is if you look at the average nuclear reactor rate, large scale nuclear reactor, it is, let's just say, if out of 100% build cost, the cost of an operation cost, the fuel source, the plutonium, is
4% of the total operations when you count safety, personnel, water disposal, all of the things around it. And so if you look at the amount of supply of plutonium in the world and where most of the mines are, a lot of them being in Russia, if we took that, and even if the price of plutonium quadrupled, then that means that your portion of the budget goes from 4% to 16%, which is it's a big increase, but it's still not. I mean, that's within the realm of okay price overruns. That just gets passed on to the consumer, and you're not. That's not doubling your price of energy, right? So your underlying fuel source could quadruple, whereas right now, if natural gas 4x'd, right, that would be a massive hit to everyone that uses that as an energy source.
It'd be devastating for sure. Yeah.
And we've seen a lot of that across Europe, just with the cutoffs from Russian gas pipelines.
Yeah.
Anything else on this you want to touch on, Dustin?
No. I think this is it's interesting. It's going to be, I again, depending on the views of climate change and all of that, I think I'm more excited for an environment where we're going to see some innovation, right? I think, and I've been reading some articles about that just in the wake of the Trump victory. There's a lot of folks who are excited to get some. They're excited about the possibility of deregulation, the removal of red tape, and the ability to just get down to work building some stuff. And so I'm personally just excited to see what kind of solutions to these problems come out of the next 4, 5, 10 years. I think we're going to see a lot of progress on some things, and again in ways that we can't sit here today and fully realize or extrapolate.
The solution comes down to innovation, not more shifts to current alternative energy sources.
That's exactly right. Well, I don't know, Adam. That's probably enough for today's episode. You got anything else you want to talk about? Or
nope, all good from my side.
We'll get on out of here. All right. Well, everyone, we appreciate the time. As always, you can check out the show notes, wealthindependencepod.com. And also, if you want to, we got links to the articles that we talked about and ways to follow Adam and I on social media and get connected with the company. If you're interested, obviously, in investing, we've got a few funds out, at least one fund active. Right now, we'd love the chance to talk to you about that and talk more about some of these concerns, right? And how if you're concerned about anything going on in the world or how your portfolio might be positioned, we'd love to have a one-on-one conversation, share some ideas, share some thoughts with you. But with that, we'll get out of here. Thanks, everyone.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.